In this class I want to look at cash flow statements. There are other videos on this topic available, but one extra one won't hurt. There are several reasons why a cash flow problem may arise. Usually production takes place prior to sales. That's normally the case. In many sectors there are seasonal factors affecting the demand, which will also affect the cash flow for the business. Sometimes significant production has to take place in advance of sales, but also sometimes seasonal factors. For example, farmers can only sell their crops at a certain time of the year. For the rest of the year they may have very little to sell, so there may be a cash flow issue there. But there are examples of Christmas cards and decorations, since they are demanded at certain times of the year. Now, the companies that make Christmas cards must diversify and produce something else to stay in business, but the main sales may be around the Christmas period. So they may have a cash flow issue associated with that. And generally there is a lag between the sale of goods and receipt of the cash, and that must be bridged. The company must have cash to keep it going in that period, otherwise the company will go out of business. It must survive the period between the sale of the goods and receipt of the payment. And in some cases that could be some time. It may be that custom and practice within the industry says that the buyer gets 30 days interest-free terms, which means they don't have to pay for the goods for 30 days. Well, that 30 days must be bridged by the company selling. It must have cash to survive the 30 days, pay wages, pay bills. So cash flow is important. And having a cash flow statement is absolutely essential when negotiating an overdraft with a bank or negotiating any form of credit. They need to see how well the management is able to control its own expenditures. It's possible for a profitable business to be short of money. Simply by selling the goods and having to wait for the receipt means the business is profitable, it's made the sale, but it hasn't received the cash. So it's short of money. So there needs to be a balance between the two, and the company must make provision for that gap. But there must be a balance. It must come into balance in the long run, but in the short run there could be a gap. Now the cash flow statement focuses attention on the most critical aspect of short-term financial management. That's the day-to-day handling of cash resources. The day-to-day handling of those resources is essential if the business is to continue. It must be able to pay wages and other expenses, as I said earlier. The statement entails making detailed estimates of when cash will be received from both cash and credit sales, and when cash will be paid to the various resource suppliers, including workers, managers, but also raw materials, pay for energy, electricity or gas, transport, and so on. So the business must have a plan on how it's going to meet those obligations, given the fact that some of its sales may be on credit terms, which means it doesn't receive the cash for a certain period of time. Or it could be the case that sales are erratic. Some months they sell a lot, some months they don't sell much. So it sets out a cash flow statement looking into the future. Because it's looking into the future, it's ultimately estimates, and the assumptions behind the estimates must be made explicit. You must state the assumptions so everyone who reads the accounts, or reads the statement I should say, is clear what the estimates are based on. So statements are prepared at regular intervals for the following reasons. It needs cash to facilitate day-to-day transactions. The business needs the cash to do that. It must therefore ensure that the cash is available to cover obligations, for example paying wages and day-to-day functioning, as I said earlier. It'll also want to avoid excess cash in the bank, which is known as idle cash. If it's got too much cash in the bank, some of it could be put away into other accounts, high interest earning accounts, so that it's bringing it back a return to the business. Obviously there's a balance there to be struck. As I said, excess cash is wasteful, but not enough cash is a disaster. So a balance must be put into place. Okay, so let's look at a fictitious statement. We'll have it for ABC Limited. Now, here we have the receipts from January to June. We have the receipts. I'll put the cursor onto the screen. We have the receipts here. We have the payments down here. Stocks, labour, rent, loan payment, services, electricity, etc. So if we add up all of the receipts, cash receipts, debtor receipts, we get to 1,000. And if we add up all of the payments, it comes to 740. So the net is 260. Now the opening balance is, let's say, 150. So the closing balance will be 260 plus 150, which is 410. And that closing balance will become the new opening balance. Now over here we've got receipts 700, and coincidentally the payments are 700, so that there is no net flow here. So the opening balance is 410, which also is the closing balance. Next one, 630 receipts, 740 outgoing. We put it into brackets. That's the same as a minus sign in accountancy. So it's negative 110. Starts with 410 carried forward from the previous month, and that of course is just reduced down to 300 because of this loss here. Subtract 110 from 410, giving us 300. So now it starts April with 300, and so on. In March, April, May, payments are greater than receipts. Now the assumptions as to why that's the case need to be emphasized, need to be brought out. So it's important to make clear, make explicit all of the assumptions behind the cash flow statement. But that's how a cash flow statement is worked out. The receipts, the payments, subtract them, that's the net cash flow, and then any opening balance, and the closing balance in any one time period becomes the opening balance in the next time period. So it seems straightforward enough, but it is a very important document. That's all I need to say on this topic, I think, so thank you for watching.